Hi, everybody. My name is Alex Buriak, and I'm the Senior Vice President over here at Jet Lending. And as you guys are aware, may not be aware, we always have live education. So feel free to make comments or anything like that in any of the social media channels that you're watching this, and I can get some of your questions answered. But today, our main topic is why do investors use what's called DSCR loans or debt service coverage ratio loans? A few years ago, they were called non QM or non qualified mortgage, but they changed the name and they're called DSCR. So let's define everything first so you know what everybody's talking about if you haven't used these in the past. So what happened was there was a product that was created for investors to hold real estate. The financial world got very wise to the importance of holding real estate. Anybody who's been paying attention over the last, I don't know, 3 to 5 years, you guys have probably seen a lot of major firms, REITs, hedge funds, and family offices. I mean, look at BlackRock and Vanguard and all those kind of things. They're buying real estate and they're developing subdivisions to hold for rent. So, the word is out on how you get really wealthy, and investment real estate is not flipping, it's holding. So, DSCR loans, the definition is it's the debt service coverage ratio loan. What does that mean? So instead of being like in a conventional loan, when you guys bought your primary house, this is all based off of basically three criteria. One is your credit score. You usually need about a 660 or higher to be approved on a debt service coverage ratio loan. Then it's just basically based off the value of the property. It's usually 80% on a purchase or 75% loan to value on a refinance. But here's where the DSCR comes in. And this is what makes it very attractive. So DSCR is your principal, your interest, your taxes, your insurance, and any association dues, your PITIA. That's your mortgage. So if your mortgage was $1,000 a month, for easy math purposes, that means that if you needed a 1.2% DSCR ratio, that means the property would need to be or could be rented for $1,200 a month. 1,200 divided by 1,000 is 1.2. So that's basically what everything's based off of, is that ratio, that the collateral supports itself plus X amount percent. So you'll see loans in the 1.0s, the 1.1s, the 1.2s, the 1.3s. The higher the ratio, the lower your rate comes because the property stabilizes itself. How do these deals work? Well, they're usually backed by securities. And what does that mean? It means as lenders, like even Jet Lending, we will deploy 30-year loan paper, but it's based off of different kind of pension funds and maybe life insurance funds or different types of securities. As those loans aggregate, those are been sold off. Okay, so nobody really holds 30-year paper. I'm sure you guys have had your conventional loan sold many times. So 30-year paper is always traded. All right. What does that mean? Well, when you're using like regional hard lenders like Jet Lending, it was probably an extremely easy process because it's a lot of common sense lending that goes into hard money lending. When you get into securities and when you get into things like that, sorry, thank you. You will get into a lot of underwriting conditions. Okay, so when that happens is you have to kind of prepare for about a 30-day, probably a 40-day close, because anytime you get securitizations involved, it's a longer process. Okay, because they don't see common sense lending. One of the things that you'll notice is the most nervous person in the room is usually the banker. They are there to not lose money, not to make money, and there's a difference. So investors use DSCR lending because when you go conventional at prime 8.5 right now, the DSCR rates at 8 to 9 aren't that much different than prime. So when you go conventional, you may get a 6.5 or 7.5% rate, but you have to show debt income ratio for all your properties. You have to make sure that you have all your docs in place, all your tax returns. So it's a very cumbersome process. When you're an investor buying in volume, your biggest value is speed. Okay, so when you're doing this, it's a faster transaction. You need less documentation, but you just have to be very attuned that there is going to be things that you're going to need to provide, and conditions to cure as underwriting looks at your things and things like that. So it's a very good way for you to scale your rental portfolio by using this type of lending. And that's where a lot of these people will go to events and will do educational broadcasts and things like that. And they'll say, Alex, I've heard of investors buying 20 rentals in a year. Yeah, this is how they're doing it. They're usually buying it with a hard money lender like Jet Lending. They're coming out of pocket very little amount of money. They're fixing the properties up because they're buying them distressed. And then they're refinancing out at 75% or 70% on the DSCR loan, depending on where their credit scores and their debt service coverage ratio lies. The top is usually 75% on the refinance. So if you're in it very low at 70% with your lender on the front end on the repairs, and you're refinancing at 75%, and the values come well on the appraisal, then you are actually coming out of pocket less or nothing on your even second closing. So, and you got to understand that when you go into long-term lending, basically the appraisal is gospel to them. So it's very important your property looks very good. All your finishes are complete, and you make it a good showing for that valuation. Okay. So DSCR lending is just another vehicle to get things done. It's a way to scale your operations. It's a way to scale your inventory as a landlord. So there's a lot of different ways you can do it. We'd be happy to show you guys the ropes on how to get these deals done. If you want, I'm going to put in the comment section too. That's already in the title, but come to www.jetlending.com. Check out our education page. A lot of even the calculations and how you should calculate these things and how you should negotiate these things. We make a ton of videos on those. You can get pre-qualified. You get your loans analyzed and see how we can really help you scale when you're trying to be a landlord, or you are a landlord and you're looking to buy more. So I hope this was helpful. I hope this was informative. Check out some of the other videos where we go over some of the math. But this was basically just a way to give you guys an idea of what you keep hearing about DSCR lending and what it is. It's basically a lending vehicle that uses the ratio between your rent and mortgage to make sure the collateral stands on its own. Again, I hope this was helpful. If you guys have any ideas on any kind of videos that you guys need, some burning questions that you think is going to help scale your business, let Jet Lending know. We'll get it out there and make sure those questions are answered. I hope you guys have a great day, and we'll talk again.